to Forex. So welcome once again. All right, so we'll go through the Forex Basic and what's Forex, you learn the foundational stuff you need to know to become a trader. All right, so I'm not going to go through this. There's some things I'm going to skip because of time, so that the ebook is available. You go through it yourself, you read all this stuff, and all that. So Forex, of course, it is short form of foreign exchange. So Forex market is where banks, businesses, governments, investors, and traders come to exchange and speculate on
your video.
Can you see my screen?
Yes, very clear.
Okay.
Good morning.
The Forex market is also called FX market. People refer to it as FX market, currency, foreign exchange, currency market, foreign currency market. Is actually the largest and most liquid in the world, with an average turnover is currently over 5.3 trillion, over 6 trillion right now. That average turnover of that is over 5 trillion, 5.3 trillion. Now you read about this history of Forex. I'm not going to go through it. You can read about it. So now these are the Forex market participants: central bank, institutional investors, commercial banks, companies, individuals, brokers. All right. So there are advantages of Forex trading. We have small commissions, very on your broker, low transactions cost, spread, bid and ask, no fixed trade, risk size. You can have you can use lot range from 0.01 to 0.1 to the 1 lot, and 50 lots, 100 lots, 500 lots, as much as your broker allows or your account size allows. Now, it takes low account size to start. All right, so from between $25 to $300, you can start trading. So it's a 24-hour per 5 days. That's 5 days per week. Market closes on Friday night and opens Sunday night as well. Now, another thing about the advantage is leverage. You can control large amounts of money with small capital. Now, it also allows you to keep your risk management tight with nice profit potential. That means you can risk little and gain a lot. You can get in and out of a trade at any time. All right, so now we have major Forex pairs. The major Forex pairs are USD, we have Euro, Japanese yen, that's JPY, GBP, which is British pound, Swiss franc, Canadian dollar, Australian dollar, New Zealand dollar. That's because of the economy and how strengthened, how these currencies are used globally. So they are referred to as the major Forex pairs. Now, these are the like the nicknames for them. All right, Euro USD, they call it Euro, USD JPY, dollar yen, cable or sterling, that's GBP USD, USD CHF, Swizzy, and all that. You can go through this as well. So now let's cross currencies. Crosses, or rather minor currency pairs. There are currency pairs that do not contain the US dollar. They are called cross, all right? So any pair that does not contain the US dollar is called a cross currency, all right? So now we have Euro GBP, Euro CHF, Euro CAD, that's Euro Canadian, understand, Euro AUD, Euro Australian dollar, Euro NZD, Euro New Zealand dollar. All right, so there's all that you can go through it as well. So these are what we call cross or minor currency pairs. Now, exotic pairs are made up of a major currency paired with the currency of an emerging or a strong but smaller economy from a global perspective, such as Hong Kong, Singapore, European countries outside the Eurozone. So you have this called exotic pairs. Usually, so many people do not trade it, and then the spreads and all that are usually very high. All right, so you have the Euro, Turkish lira, and all that, Euro, USD, Norwegian krone, blah blah blah. You have all. So these are exotic pairs. They are currency with an emerging or strong but smaller economy from a global perspective. Now we have the different trade sessions in Forex. Now this time are all in EST. EST, that should be 6 hours. we are 6 hours ahead. So you add 6 hours, you get your GMT. We are in different times, depending on where you are from. So GMT plus 1, London will be 8. All right, 8 to 2, 8. I'm sorry, yeah, 8 to about 8 to, that should be about 8 to 6, 7 thereabouts. All right, so you have New York. New York starts at time 2 p.m. Yeah. All right, 2 p.m. GMT plus 1 and all that. So these are the sessions you have for Forex. We have the Tokyo session as well. All right. So now the idea of Forex is about you buying and selling. So you buy when the market is low. Sorry, when the market is low, you buy. So that when the market rises, you can sell to make a profit. All right. So once you buy, you have to sell your position at the end of the day to make a profit. All right. So now, long, when somebody says we are going long means buy. It means you are buying the base currency and you are simultaneously selling the quote currency. So if we say Euro USD, that's Euro USD, that means we are longing Euro USD, means we are buying Euro and we are selling USD. When we go short, it means you are selling the base currency and buying the quote currency. So the base currency is actually the first one and the quote currency is the second one. All right. So now, so if I say I want to sell Euro USD, it means I want to buy USD, that's the quote currency, and sell Euro simultaneously. So that's what it means for that's the term buy and sell when it comes to Forex. Okay, so now in Forex we have the bulls and the bears. All right, so the bull market is characterized by a rise in price. The opposite of a bull market is a bear market, which is characterized by falling prices and typically shrouded in pessimism. So the use of bull and bear to describe markets comes from the way the animals attack their opponents. Bulls fight up, while bears, they fight down, their head coming down. That's how they fight. So when they say the bullish market, you must have heard the term bullish market, bearish market. That's what it means. So bullish market means the market is up, the market is trending up, it's buying, it's strong. Bearish market means the market is selling. So that's the term bull and bears. Now, talk about some of the important things in the basic 2. We have the pips, how to calculate pips are the important one. This is how money is made. This is what Forex is about. So these terms are very important. So you have to pay attention to this section. All right. So pips. What are pips? Pip is a price interest point. The unit of measurement used to express the change in value between two currencies is called a pip. So if Euro USD moves from 1.2250 to 1.2251, that is a 0 point that if you deduct it, you have a 0.0001 USD rise in value. So that is 1 pip. If USD JPY moves from 112.25 to 112.26, that's a 0.01 rise in value. That 0.01 rise in value is 1 pip. Okay, we'll see why this is different. Why this one 2, why this one 4, and all that after the decimal point. Now, the pip value for these two kinds of pairs, that's the ones that have 4 digits. You can see Euro USD has 4 digits after the decimal point, while USD JPY, any pair that is paired with JPY has 2 digits usually after the decimal point. So now, how do you calculate pips? Because pips are very important. Pips is what you use to know how much you are making in the Forex market or how much you are losing, because it is it's used to express change in value. So how do you calculate pips? Now let's go to practical class. Now, like I said, remember we have 2 kinds of pairs. We have the 4 digits and the 2 digits pip pairs value. All right. So now let's assume that we entered a buy trade on GBP AUD, Great British Pound and Australian dollar at 1.82446, and we exited at 1.84565. So now let's calculate the number of pips made. Now, since it was a buy trade, we make profits. All right, that's what this trade is trying to tell us, this particular one. But let's forget about profit or loss and all that. So now when you subtract, we subtract this from this, we have 0.02119. Now we're trying to calculate the pips. Now this value is not the pip. Now what you need to do is not in its complete state. You now need to move, you slide the decimal. That's the easiest way to calculate it, although we have an automated way on the chart that you can just use to calculate. But let's learn the manual one first. So you slide the decimal point 4 places. All right. So 1, 2, 3, 4. When you slide the decimal point 4 places, the whole number in front of the decimal point is your pip value. So after sliding 1, 2, 3, 4, we have 0.00211.9. So the pip gain for this buy order, for this GBP AUD buy order, is 211 pips. 211 pips. All right. So now let's calculate pips on the second type of pair. Like I said, JPY pairs, they have two digits after the decimal point. Okay. Now let's assume that we entered a sell trade on Euro JPY at 130.684 and we exited at 128.567. What's the pip gain on this trade? So you subtract again. When we subtract, we have 2.117. Now, for this kind of pairs, JPY pairs, we are going to move it only to, take note, only to the first type that has 4. We move it 4 places. They have 4 or 5. Sometimes they have 4, 5, 6. We move it those on 4 places. 4. This one, you move it 2 places. So now we move the decimal point 1, 2. The whole number in front of the decimal point is our pip value. So anytime you subtract and you move your decimal point, either 2 places or 4 places, the whole number is your pip value. So that's an easy way to calculate your pip. So now the pip order, the pip value for this sell order is also 211 pips. Okay. All right. Now we're going to talk about lots. In Forex, positions are quoted in terms of lot. That is, you see somebody, you hear the term 1 lot. How many lots are you entering that trade on? 2 lots, 10 lots, 20 lots, 30 lots, 0.2 lot, 0.01 lot. Now let's talk about what they are. Standard lot number of units is 100,000. That means the standard lot you can control 100,000 units. Mini lot is 10,000. Micro is 1,000. Now let's learn more about this. So this is how money is made when you combine lots and pips. This is how money is made in Forex. Now we have a lot size, we have a micro, which is 0.01. The pip value is 10 cents per pip. All right. So if you are using a micro lot of 0.01 or 0.02, 0.03, every move is going to move by 10 cents or 20 cents or 30 cents, depends. So let's just stick to 0.01 first. So 0.01, 10 cents per pip. Every move is 10 cents per pip. Every move is 10 cents per pip. The mini lot, 0.1. Every move's pip value is $1. $1 per pip. $1 per pip. All right. So if I put 0.10 lots to buy Euro USD and Euro USD moves 2 pips, I'm going to make $2. If it moves 5 pips, I'm going to make $5. So every move is $1 per pip. Then standard lots, which is trader's dream, every pip move is $10. Every pip move is $10. So depending on your account size, later on you get to know what size of lots you should be using when you're trading. All right, because with lots you can amplify your profit. You can also blow your account depending on how you should use it. All right, so assuming like we made in our previous example, now we talked about 211 pips. Now let's see how this translates to money. So let's assume that we use a lot size of 0.01. The value is 10 cents per pip. So we're going to have 10 cents times 211, which is $21. $21, 1 cent. Now, if we use the lot size 0.1, the value is $1 per pip. So when you multiply $1 by 211 pips, you're going to have your profit is going to be $211. Then if you use 1 lot on that trade, the value is $10 per pip. Now, $10 per pip, the profit you're going to make is going to be $10 times 211 pips. You're going to make $2,211. $110. So that's how money is made in Forex when you combine lots and pips. All right, so now let's move on next. So the bid and ask price. The bid price is the price which the market, your broker, will buy a specific currency pair, because when you are buying, you are simultaneously selling. That means the broker has to pay you, somebody wants to sell, or they themselves. Because of course they do that. Brokers also they trade against traders sometimes. So that's it. So they when you are buying euro, remember when you are buying euro, you are simultaneously selling euro USD. That's if it's euro USD you are dealing on. All right. Then the ask price. So the bid price is a price you can sell the base currency to your broker. The ask price is the price at which the market or your broker will sell a specific currency to you. So when you look at your trade, you're going to see price moving like this. You see these two prices. So one is the bid, one is the ask price. Now the difference between the bid and ask price is the spread. Spread is how brokers make their money. Now imagine, for those of you in Nigeria, everybody knows Aboki. If you go and tell Aboki that I want to buy dollar, they will give you a price. If you tell them I want to sell dollar, they will give you a price. But the price they will give you when you want to buy and when you want to sell, they are different. Because that is their spread. That is how they make money. They buy and they sell. You understand? So just assume that's the same example for this. This is how brokers also make their money, with the bid and the ask. You understand? So that the difference is their profit. That's how they make their money. All right. So now let's move on. We talked about spread already. It's difference between the bid and the ask price. So if you see, you just deduct it. That's all, and then you get your spread. So that spread, that 2.1 pips, and whatever it is, that translates to in dollars. That's what the depending on what you are using. That's the brokers that's the brokers' profits from that trade. All right, so they are in business. Of course, they will make money. All right, so margin. Okay, margin, very important. Margin. What is margin? You're going to see that on your when you start trading. You're going to see it on your MT5. Mostly now we use MT5. Nobody, I don't think anybody uses MT4 again. So MT5, you're going to see that. I want to explain it in a way that will be easy to understand. Margin. Okay. So now, let me read from this. Leverage. All right. Sorry, let me read. Margin is the amount of money you need in your trading account to open and hold a trade. So you have to think of it as a security deposit that your broker holds while your trade is open. So let's say you want to buy something worth $1,000, but you don't have all the money. All right. So your broker says, "Don't worry, just give me $10 and I'll cover the rest. But if things go bad, I'll keep your $10. That means if you lose the trade, your $10 is gone. But when you put that $10, you are able to hold a position that is bigger than that $10. That's the leverage. That's what Forex is about. All right. So it can work for you, can also work against you. All right. So now in Forex, margin lets you control larger trades with a small amount of money. That's why you see some people sometimes with $10, they can make up to $1,000. All right. So that's because of the margin and leverage. So why margin is important is because it allows you to trade bigger sizes, more profits, but also in the reverse, it can also be more risky, you can also lose more. So you use something called leverage, like trading with borrowed money. All right. So margin isn't a fee, but if your trade loses too much, your broker will close your trade automatically to protect their loan. So this is called margin call or stop out. All right. So if your broker offers like 100, you see brokers offer different kind of leverage, 1 to 100, 1 to 1,000. Some people offer 1 to unlimited, like Xness. All right, so that means so for every $1, let's assume 1 to 100. That means for every $1 of your money, you can trade $100, as you can hold $100 position for every $1. So if you want to trade $10,000, worth of position, you only need $100 margin to trade that. So that's the beauty of Forex. All right. So in summary, margin is the money needed to open and hold a trade. It gives you access to bigger opportunities, but it also comes with higher risk. All right. So that's it. So we're going to move on to, okay, who's a trader? A trader is a foreign exchange trader. A foreign exchange trader or currency trader is a person who trades, buys, or sells currencies on the forex market. Okay, so now something very important. Okay, forex orders. Now, forex orders, when you want to place a trade, what kind of order are you going to be taking? It depends on the kind of trade you are taking. All right, so I'll give an example later on. Now, market, we have two types of order. We have market order, which is instant execution in some brokers. Some people know that instant execution. Some people know it as market execution. The market order is an order that is placed at the market. It is executed instantly at the best available price. That means there's no waiting, nothing. You are telling the broker, you're telling the market, I want to enter at this price. GBP USD is at 1.1333. I want to buy now, instantly. So when you press buy, your order is active. Immediately it's active. Can either be profit or loss. So that's what market execution is. Then we have limit orders. Limit orders are 4. They are called pending orders. So we have different kind of pending orders. We have the buy stop, we have the sell stop, we have the buy limit, we have the sell limit. We're going to look at an example. That was shown on the screen and you might not really understand it, but let's look at it anyways. Now for buy stop, you want to buy a pair at a certain price. 1.135. My analysis tells me this is the best place to enter this trade. 1.135. So the market is not yet there. It's buying, but it's not yet there. Now this blue circle represents the price. So I now when I want to take a trade, maybe because I don't want to be on my system and all that, I want to go and do something, I'll place a buy stop. Now that buy stop is telling the market that, see, I want to enter the market at this price. So when you get here, activate my order. So when you place the buy stop, when the trade gets there, you're going to activate your order. Buy limit is, my analysis tells me that the market is, even though the market is selling, you can see the blue price, the price is dropping. Even though it's selling, my analysis tells me that at that green point at 2.15, market is going to buy. Maybe that's a strong demand zone. The market is going to buy there. So I'll place a buy limit order. When the market gets to that place, it's going to, if my analysis is correct, it's going to pick up my order and then start moving up, buying. Do you understand? All right. So sell stop, the same way, the opposite. Price is coming down. It's selling already, but I say, I'm not so sure of this sell. I want it to come further down. Let it get to 1.005. That's when I want to enter. So I'll place a sell stop order. When the market gets there, it's going to activate my order. All right. Sell limit is the same way. Sell limit, opposite of buy limit. The market is buying currently, but I can see a resistance or a supply zone. And I'm saying, okay, I'm sure the market is going to drop there, but it's not there yet. But this is where I want to buy. So I'll place a sell limit order and say when the market gets here, activate my order. And then the market activates my order and I am in the trade. All right. And then it sells and I make a profit. All right. So now, when we want to place an order, there are different kinds of that the parameters you need for market execution order. You only need the order type, that you state the order type, and then stop loss and your take profits. So you just select instant market execution or instant execution, depends on the broker, what they call it, and then you place the trade. There's no price, you understand, entry price, because the entry price is whatever price the market is at that point. That's your entry, because it's an instant order. Now, pending order, You need everything that the market execution order, the same thing, but with one extra one. You are going to have to include an entry price, because your order is not an instant market execution order. You want to enter as a specific price, so you are going to put your entry price. When you put your entry price, when the market gets there, it's going to activate your order. So pending orders will not be active immediately. It will just be pending till the market gets to your value, the value that you put as your entry price. When the market gets there, it activates your order, and then you are in the trade. All right. So that's what you need. So you're going to see all this on your on MT5 when we're going to do a practical session, mobile session for that. I think we should be able to do that next week. Yeah, we just have 2 classes. Okay. So leverage is actually like borrowed money from a broker that allows you to control a large size with a small amount of your money. Remember, I talked about margin, they work together. So it's like using a booster to lift something heavy that your muscles alone cannot carry. All right. So if you want, imagine you want to buy a car worth $10,000, but you only have $100. Like you want to trade the position up to $10,000, but you only have $100. So the dealer will say, no problem, I'll lend you the rest. Just pay a deposit, small deposit. So that small deposit is called margin, and the helping hand is leverage. So as you trade, you with that $100, you'll be able to you can make profits up to 10,000, even more than 10,000, because you are leveraging. The broker offers you either a 1 to 100 leverage, or 1 to 1,000, or 1 to 5,000, or 1 to even, like I said, unlimited in some cases. So you can actually control large amount of money. But leverage works in both ways. So the more you leverage, the more profit you make, and the more you leverage, of course, also on the reverse, the more you can lose. So that's it. That's why you're going to have to apply proper risk management. All right, let's move forward. All right, so brokers, what are brokers? Forex brokers are firms that provide you with access. You are not a forex trader. For you being here, you're already a forex trader. You want to be a forex trader with access to a trading platform. So they allow you buy and then sell foreign currencies. All right. So, demo life account. You can read about this and all that. All right, let's go to section 3. Very important. So we're going to see all these ones live when we're doing our introduction to trading view next week, Thursday. So we have different kind of line of charts. We have the line chart, we have the price bar chart, we have the candlestick. Candlestick is what we mostly use, so you just focus on the candlestick chart. All right. So time frames, we have different kind of time frames that we analyze. You can analyze your chart on. Remember, you have to do an analysis to know if you should buy or sell, because you make money in market if your prediction or your analysis is correct. If you want to buy and the market buys, you're actually going to make money. If it goes the other way, you lose money. So we have different kind of time frames you can analyze on. We have the 1 minute up to the 1 month time frame, 6 months, 3 months, 45 minutes, 15 minutes, 5 minutes, and all that. So this ones you're going to learn later on, the best time frames to use for analysis and also for entries. All right. So now trends, very, very important. There are 3 types of trends in Forex. We have the uptrend. Now the uptrend is when the market creates higher highs and higher lows, and movement is upward. Downtrend is when the market creates lower highs and lower lows. That's like you're descending from a staircase. So uptrend, you are ascending, you are going up the staircase. Higher highs, higher lows. The last high is higher than the next high is higher than the last high. The next low is higher than the last low. So that's an uptrend, just going up, staircase. Use that to illustrate that, to remember an uptrend. Downtrend, you're descending your staircase. All right, sideways, we have sideways and ranging market. This is when there's no higher lows, no lower, the market is just ranging, just moving side to side, just ranging. All right. So uptrend is also known as a bullish trend. Downtrend is also known as a bearish trend. While sideways trend is known as a ranging or consolidation market. Price is just, there's no higher high or higher low being formed or anything, So that's it. So bearish trend always opens at the top and closes below. Bullish trend opens at the bottom. They are moving, of course, upwards. So open at the bottom and then it closes above. All right, so now this is an example of the trend. The first one is the bullish trend. You have the low, you have the high, then the next low, high, low, high, low, high, low. Actually, it's higher low. I'll call it higher low. All right, higher low, higher low. So you can put higher in front of the low because the last one, the next one is higher than the last one. You understand? Higher low, higher low. The downtrend is correct. The downtrend, we have the lower high, lower low. You are descending down your staircase, lower high, lower low, lower high, lower low. Then we have the consolidation market. Consolidation market is just, zigzag, zigzag. It's just moving, consolidating. So these are the three kinds of trends that we have in the market. Okay, so now we'll talk about risk management. You're going to learn more about that. These are the recommendations. The lot size is based on the account size. You should be using 0.01 for $100, 0.1 for a $1,000 account, 1 lot for a $10,000 account, and 10 lots for a $100,000 account. So you can read about risk management as well. So psychology, very important. Another thing for you that's very important is your psychology. So yeah, let me just read this out. So you have probably heard that most people who attend Forex trading end up losing money. To be honest, only 5% of the people who attend Forex succeed. You being in our community, you have to be in the 5%. It's a must because you must succeed. So there's a good reason for this. And the reason is primary that most people think about trading in the wrong light. So you have to have the right mindset when you're coming to trading, right? Most of the mistakes you'll be able to avoid it. So most people come into the market with unrealistic expectations. They are thinking they're going to quit their jobs after a month of trading, or thinking they're going to turn $1,000 to $100,000 in a few months. So this unrealistic expectations work to foster an account destroying trading mindset in most traders because they feel too much pressure or the need, to make money in the markets. When you begin trading with this need or pressure to make money, you enviably end up trading emotionally, which is the fastest way to lose money. Emotional trading. So you have to get your psychology, you have to get your mindset right. Treat Forex as a business, long term, and you find out that you'll be consistent in profit overall. Yeah, you're going to win, you're going to lose some, of course, but your wins with the right strategy, which we are going to be teaching. We have one of the best strategies. Your wins are going to be more than your losses. All right, so these are the emotions to watch out for: greed, fear, revenge, and all that. Euphoria, so a good book I recommend is Training in the Zone for trading psychology. I'm going to try and get it sent to the channel so that you guys can go through the book as well. It's a good psychology book. It's number one for Forex trading community, Training in the Zone. All right, so we have analysis. We have three kinds of analysis. We have the sentimental analysis. We have fundamental analysis that has to do with news, and we'll call them red folder news. Those news, they move the market a lot. So we have technical analysis, which is what we mostly do. Is based on, in fact, 100% we do technical analysis, study of charts and price movement. For me personally, I believe that fundamental analysis just moves price to where price is supposed to be. So once you get your technical analysis right, you should be good. Okay, so if you read about fundamental analysis, I'm not going to read all this. Is the study about the global economic news and other news affect financial markets. So when the news is about to be released, there's some people that trade news. They just most times it's gambling because it's either going to spike up or spike down. All right, so we have different kind of news events that move the market. We call them red folder news. You're going to see them. There are different interest rate, housing data, employment indicator, blah blah blah, consumer price. So technical analysis is what we do. Now, this is a sample of a list of news release in a day. So we have the red folder. Red folder are high impact. Orange, when you see the orange, is medium impact. It's not really. Then yellow is low impact. Doesn't even move the market. News just happens. You just read your news or whatever, release the news, and that's it. But red folder, most times it moves the market. In a big way. Yeah. So there are 10 simple trading rules. You can go through them as well. All right, so with that brings us to the end of our basic 1. Okay, so next week we are going to go to basic 2. We're going to finish basic, just 2 classes. We're going to finish basic 2 next week, Thursday. We'll get to learn. We're going to go into trading view, introduction to trading view. You're going to see some live examples on the chart, what you've seen in the book. You're going to see it on the recharts and how it works. Also, how to take trades, MT5, and all that. Open your broker account, so we'll do those ones next week. So that's it. All right, so does anybody have any question for roundup? Does anybody have any question? No question. All right, so that's it. So have a wonderful day ahead. God bless you. We'll meet again next week.